So before we discuss about the accounting treatments with respect to futures contract, we should be sure with what is the concept of margin money. As we said, future contract is one of the standardized one where the stock market directly intervene in the conduct of this trade within the market. So that's the nature. It is a standardized one. And accordingly, the future while entering into a future contract, you have to bring in the margin money, which is nothing but it is actually computed on the basis of the total transactions which you are planning to conduct, as well as based on your credit worthiness and your track record with the trader, with the trading partner. And when you are opening a future position, you definitely have to have margin money, which is deposited with your trading partner, or maybe with your broker. And what we have to understand is it is not a down payment, like as we go for purchasing an asset, maybe we will go with an advance payment before we pay the whole amount, but we get the ownership of that, and in installments we make the payment towards the expenditure for that asset. That is not something with respect to margin money. When we are talking about margin money, it's not a down payment, nor you get the ownership of the asset. It is if you have to open a future position with a stock market, the depositing of margin money is mandatory. It is actually for you to enter into the market, not to become the owner of a financial asset or maybe a physical asset, whatever be the underlying asset. So when we are opening up a standardized derivative transaction with respect to option or with respect to future, this is a concept which comes into play when we are having the transaction with the broker. Option, of course, there is some difference which we are going to discuss in our next day's class, but for future, this is a mandatory no. Okay, now this margin money can be paid by making a deposit, okay, which has been, say, the stock market would say that, okay, suppose if I'm planning to invest in stock index, based on my risk exposure, my margin money will be computed and it will be discussed with me, where I make the deposit into my broker's account, okay, which is opened in my name. I would be called as a client in the client's name. And there can be another way of setting for or arranging for margin money, where I make a lump sum amount. I deposit a lump sum amount which will be much higher than the requirement, and only temporary adjustments will be made by me as and when there is some kind of daily settlement, where based on the daily mark to market situation, when the value of my underlying asset change, accordingly the margin requirement can increase or decrease. So that will be done on a daily basis, but I can also deposit a money, or in some cases when for institutional investors, or if the broker allows, some cases the guarantee will be provided by the bank. Money may not be actually engaged or deposited, but a guarantee, bank guarantee, or maybe you will give some kind of security asset as a security. Collateral will be given by you instead of liquid cash. In any of these cases, that has to be specifically mentioned in your, finally when you bring up settle your balance sheet, or also in your disclosure notes. It needs to be shown exactly how you have maintained your margin money. See, so in short, margin money is the preliminary requirement for opening an account with a broker in order to conduct the future transaction, or in order to deal with future derivative contract. Okay, so this is it. And now we are slowly looking into how are we accounting for in books of account with respect to a future contract. We would be looking at it from the angle of a buyer and a seller, and the other parties who are involved in the trade, maybe a banker, maybe a commission agent, or maybe other facilitators who go with facilitating the contract. There the treatment is no, it is same with respect to the stock market. Suppose if you have got a commission for the services which you have done, it will be recorded as your income in your P&L. There is no difference in with such type of treatment. So we are specifically looking into how this is recorded in the books of a client, because that is where we can notice some difference with respect to accounting, or with respect to the treatment of transactions when we compare with the stock market and also a derivative market. So we are looking into how the transactions are happening in the books of accounts of a client. Okay. As I said at the beginning, we are looking into how the accounting treatment happens with respect to a future contract. Future contract, as we know, is a standardized one that happens through a stock exchange. And broadly, I have classified that into four. The one at the time of inception, the accounting treatment at the time of inception of the contract, the journal entries and how it has been recorded in the books of account at the time of inception, and on a daily settlement. And the next one is when we have an open position, which is not closed even at the close of the financial year, the settlement of the bank, the settlement of the balance sheet, preparation of the balance sheet, that is called as open position. And at the time of final settlement, where all our transactions been settled, finally we have decided with our profit or loss in a particular dealing. Okay. That is it. And the last one is in case of default. So these are the four conditions in which we would be going with discussion of our accounting treatment with respect to future contract. Okay. So let's start with the first one. In case of, it's very easy for you to understand. The concept is not different. Only thing is that you have certain new category of accounts or ledgers which you have to open when we are trading with the future contract. Okay. So the first one is at the time of inception, as we said, we require a margin money. Automatically, we have to create in the name of the client an initial margin equity index future account, if it is equity index, or it can be stock if it is with respect to equity stock future. Here in this case, in the first example, we are talking about margin money being deposited for undertaking a transaction with equity index future. Now, as we discussed in our previous class, in case of equity index futures, the underlying asset would be index. It can be Sensex, it can be Nifty, or any other index, maybe an international index also is possible. So the underlying asset would be that, and the value of the contract will be decided upon the movement of the index in the stipulated period. Okay, so in that case, we have to go with recording, creating a ledger account titled Initial Margin Equity Index Future Account. Okay, and the money which we are paying as margin money, it will be debited in that account. Okay, and on balance sheet date, okay, on balance sheet date, this is shown under the head current assets. Why? Because this is money which is already with the broker. The client has already paid the money in order to enter into a future contract, and it is a current asset. It will be changed based on the movement of the value of the, in this case, it is equity index. Okay, suppose if the value of index, if the value of the asset has gone up, in certain cases we have to increase the margin money. Sometimes if the index value of it came down, it has fallen. In that case, the margin requirement can be reduced. So that is why the money being in the margin, initial margin account will be shown at the fine. Suppose if it is not settled yet, it will be shown under the current assets, loans and advances, okay, in the balance sheet of the client. And as I said, sometimes this margin money can be met with a bank guarantee, or maybe with the securities, this with the investment in other kind of securities. You have deposited that as a proof. You may not have put liquid money into that. You might have deposited by giving a collateral in the form of financial instrument like stock, or maybe a guarantee. You might have given a bank guarantee taken up by depositing money in your bank account. So in both these cases, this needs to be separately shown in your balance sheet disclosure finally when you are setting up. Okay, finally, when you are coming to the close of a particular financial year. Okay. So the first condition, the first account to be opened is, it is initial margin account, and that margin account is tagged in the name of the client. If I am having an engagement with Geojit as my broker, Geojit will open an account in my name in their books. And they will debit the account with the money I have maintained as my margin. And on the final settlement, this will be put as the current asset in the client's account in the balance sheet of the client. Okay. Now, when I'm talking about guarantee, or when I'm talking about asset as a collateral, I will have to show that separately for my disclosure in my balance sheet. So this we are talking about the books of the client. Okay, we are talking about the books of the client. Maybe in my book, it will appear as a debit with respect to initial margin, and with respect to the balance sheet, it will come as under the category of, because that's money which I have deposited with my broker. So it is my current asset. As of now, whatever balance is in that account is just for conducting the entering into a future contract. And suppose if I'm coming out of the market, that money is being recouped to me. I can get it back. So that's why it's shown like that. Now, the second one is accounting on a daily settlement. Here, what we have to understand is the concept of mark to market. Okay, mark to market is nothing but the value of the asset is every time it is equalized to the value prevailing in the market. Maybe I bought the asset with by an investment of 10,000 rupees, but as of now, the value of the asset based on the market condition, maybe it is 9,000. So it's fair value. I'm marking it to the market, to the value that is appearing in the market. And basically, because of that, I will have to, for my debit or credit, I will have to know if it is my value, the margin requirement is huge, then I will have to go with depositing money again into that. Or if the margin requirement has come out, has decreased, in certain cases some clients withdrew that and make further investment, or some of them will not. They will keep it like that for they will not withdraw or make the adjustment on a daily basis. Or suppose if you're making the adjustment on a daily basis, an increase means you will have to deposit more money, a decrease means it will be you can take it out. You can credit it and take it back, the money, and maybe you can invest in some other financial instrument. And as I said, sometimes this margin money can be made as a lump sum deposit instead of adjusting it on a daily basis. In that case, we will have to open an account called deposit for mark to market margin account. It is deposit which is specifically for mark to market margin account. So whatever changes that needs to be done, if it is more money to be deposited, the deposit account, you will take the money from deposit account and debit that in the mark to market margin account. And if you're withdrawing, if you have more money than that is required in mark to market margin account, you might withdraw it and deposit in the deposit for mark to market margin account. If you have a deposit, it's not mandatory that we have to have it, but if you have it, then that adjustment will be made between them. And as I said, any balance on the date of preparation of the balance sheet, it will be shown under the category of current assets. So the basic difference which we were trying to discuss in the first is, initially you go with the deposit, and that deposit will be debited in the in your margin account, which is open in the client's name. We are talking about books of accounts of Asha. Here in this case, Asha is the client. So we are talking about books of accounts. Or how it appears in my books of account. So initially when I'm depositing margin money, when starting, that is debited and that is shown in the current account. Okay. Then the second is when there is some kind of daily adjustment that has to happen. Maybe the value of the asset has come down, or value as the asset has increased, the underlying asset has increased. Accordingly, I have to debit or credit. So that will be done on a mark-to-mark margin account on a daily basis. That's what we call as the daily settlement within 3 days. Normally, the brokers, they will do within 3 days. But if I have opened another account where I have made a lump sum deposit into that for meeting the requirements, the daily requirements that come as because of mark to market. Mark to market is nothing but you are looking into the value prevailing in the market, okay, not into the book value. Right. So mark to market margin, the difference is taken from the deposit account and then it is debited. If you need additional money, it is debited, it is credited from the deposit account, it is debited to the margin account. And in case if you don't need that much money in the margin account, maybe you will withdraw that and deposit with your deposit account. It depends upon that, how I take the situation as a client. Okay, and whatever balance here, it will be shown as a current asset in my books of in my balance sheet on the day of preparation of it. Finally, whatever is remaining, okay, it is my current asset. And then it's more or less like the money invested in stock. For a manufacturing company, the money invested in stock, it will appear as a current asset. Same here, for doing a business, I have made some investment. So that investment will be my current asset. So that's what I have discussed in the second. And in the third, open position means here you are looking at the close of a financial year. Imagine like that. And in the close of a financial year, I have still many future contracts still open to be settled. It's not finalized. The settlement date happen after the financial year, maybe in the coming June. So now March, I'll close my books of account. I'm ready to start up with the next financial year. So whichever position, open positions, in that case, if I feel that there is an anticipatory loss position left open in the balance sheet, if the requirement, if there is a loss being expected in future, definitely there should be a provision that is to be made in the profit and loss account as an anticipated loss. Okay, so that's what the next thing which we have to do for the open position, for those transactions which are not settled at the end of the financial year, means maybe I'm closing it during the current financial year, but the transaction is open, the contract is open for another 6 months. So I can anticipate whether I'm going to gain or lose in that, looking into the current trend. And if it is being said, we have to take precaution for anticipated loss. That's what we learn in the golden principles of accounting: anticipate all our losses, but not our profit. The same principle is applied here. What do? Is we anticipate the possible losses. We make a provision for that in our profit and loss account while preparing the financial statements. Okay, and it is being said, suppose if you are anticipating a profit, then don't make a provision. That's what we learn as a principle in our accounting, that never anticipate your profit. So likewise, no provision is made or it is not shown on the credit side of your profit and loss account for the anticipated profit, but definitely it is deducted from the profit by creating a provision if you anticipate a loss. That's the third thing which you have to remember. And of course, all money remaining, as we said in the previous slide, everything, all money being deposited in your margin account, which is remaining at the date of preparation of financial statement, it will be shown as current asset in your balance sheet. And if suppose if your margin money, okay, if the money to be paid to the broker is higher at the close of the financial statement, if you find that because of heavy loss, it has overshot the margin requirement, and now you have to make excess payment to the client as of the current financial year, then the opposite treatment needs to be done by you. It will be shown as current liabilities in a balance sheet, because it's not money deposited, it's actually the payment to be made to the broker. In such case, that will be shown as a current liability. Current liability, because we have to make extra payment to continue with our contract, to continue with our future contract. So in such case, that will be, it's just accounting principle. In such case, that will be shown as a current liability in the books of accounts when we are going with the preparation of financial statement. Okay, in balance sheet, it is current liability. So first we said, when we are creating an account, when we are trying to invest in enter into a future contract, we need to deposit margin money, and that will be a ledger account will be created, margin money, defining what type of instrument, maybe index future account, and we will debit the amount in that. And then we discussed about the daily changes based on the change in the value of the underlying asset, which is called as mark to market. The changes will be incorporated in a margin account. If more balance is needed, amount will be debited, and in certain cases, margin requirement can be reduced because of the reduction in the value of the asset. In such cases, either you will withdraw the money, or sometimes you will keep the money in that account itself. And then another concept called deposit margin account, where lump sum money, you are not going into mark-to-market daily adjustments by investing or withdrawing money, but you create a deposit, and from that deposit, maybe you are looking into withdrawing money, or withdrawing money to deposit in your margin account, or maybe you will withdraw from your margin account and deposit in your deposit account when there is no such requirement over there. So likewise, we told the concept of deposit account created to deposit the lump sum money for adjusting the mark-to-market situations. Okay, and third, when we told about the open position, in certain cases, some of the future contract may not have been settled in that particular financial year. So if that is not settled in that financial year, what happens here is it is taken to the next financial year. So whatever money remaining in our margin account will be shown as current assets in our balance sheet. Now, why is it shown as a current asset? Because it's money invested for us to do the business. And suppose if it happens that it's not money being deposited, it is money to be paid to the broker, excess money to be paid to the broker to keep the margin. In such a case, that will be shown as current liabilities in our balance sheet during the preparation at the end of financial statement. And another thing which we said is, when we are talking about anticipatory loss that can happen at the time of settlement of our future contract, because there will be generally a client who enters into a future market. It's not just for one contract. He might be entering into a series of contracts. The final settlement is adjusting the profit and loss associated with each of these contracts. So if the net result is there is possibility of incurring loss, in such a case, there should be a provision that is to be made in our books of accounts in order to meet that loss that can occur in the future. And as we say in accounting, never anticipate your profit, but make provision for your loss. So in case of profit, we are not making any such provisions in our profit and loss account, because that will inflate our profit. So that it will not be done, but we will make a provision in our profit and loss account by creating a charge in our profit if we anticipate a loss in the next financial year. Now, the last part which we are going to discuss is the accounting at the time of final settlement. The accounting at the time of final settlement means it is basically a final settlement which will look into whether we have made a profit or loss. And suppose if the final settlement is in such a way that we have made a loss, In such case, it will be deducted from the provision being created by us if we had a provision, or else it will be deducted from our actual profit, from our profit and loss account, because the client will be having many other, maybe he has invested in stock market, or maybe he has invested in other type of financial instruments. In such a case, it will be deducted from the profit earned in such a condition. If that's not the case, he has incurred a huge loss, which means it will be deducted from its actual capital. Money is taken from its capital. It's depleting of capital. All right. So that is the case where when we go with the final settlement. And now I have put the difference between final settlement prices and contract prices of all contracts. That's what will it will happen during the preparation of financial statements at the end of a particular normally when we look from the trader in derivative market, there will be a settlement period which he looks into and adjusts it according to his accounting cycle. It may vary from client to client depending upon the kind of transactions he entered. Some of them might have entered most of it might be 3-month contract. Some of them, they have gone up to 6 months. So that settlement happened during that time. So at times they will go with settlement to just calculate the actual position, whether they are in a profit or a loss. And if loss, that will be compensated from the provision already being created in your books of accounts, in your financial statement. And the last thing is, in case of default. In case of, the treatment is same. I have made an advance. Okay, actually, this margin money is created in a standardized transaction. The reason, one primary reason, is to protect against the risk of default in the payment. In the payment, in the sense, if I, being a client, I'm not able to satisfy a particular contract or observe a particular contract because of some financial crisis, I'll be under the category of defaulter. So if I am committing a default, the other party should not incur huge loss. So whatever money being required for settlement will be taken up from my margin money. That's a primary, one sole purpose, or maybe one important purpose of creating a margin money is to compensate at the time of, or at the event of, default being committed by a client. So if the money not being paid, automatically that will be adjusted against the margin. Suppose if there is any leftover after settlement, the money will be paid back to the client. If not, if extra money to be paid, either it will be it will be settled from its guarantee, bank guarantee, or from its collateral, or from its bank account, or it will be settled as a claim against its asset. So the last one is, in case of default, the money will be taken up from the margin money which is already deposited by the client, and then that will be closed. There is no further contract, that will be closed. The anything remaining, if extra money, that will be paid back to the client. If extra money is still remaining unpaid, it will be recouped by the client either by discharging some of its assets given as collateral, or maybe discharged from its bank account, using the legal procedure, right? So that this is actually with respect to default made by a client. So we were trying to look into what is the kind of accounting treatment, because this is pretty different from how it happens in a stock market. In stock market, there is no concept. Of course, some of the clients or some of the parties enjoy margin trading. You can pay within 3 to 4 days after asking your broker to purchase, but that's actually an internal transaction. But in derivative market, it is mandatory that you have to go with a margin trading, margin money, if you have to enter into a future contract. So accordingly, the type of accounts which you maintain in your books of accounts will be different from what is required with respect to a transaction in other financial markets. All right, so that's why we discussed it separately. When we are talking from the books of client, we require margin money account. In certain cases, that needs to be settled Definitely that needs to be settled on a daily basis. But some clients, they will deposit money excess of their margin requirement. In that case, the settlement automatically will happen through account. Otherwise, the client will have to deposit extra money if the margin, if the value of the asset went up, the margin requirement also went up. So in that case, you will have to deposit additional money. And then we talked about open position. This happens during a particular settlement period. Some of the future contracts remain open, yet to be settled between the parties. Maybe the due date is after 4 months or 3 months. In such case, we will look into the condition, and if there is some anticipated loss, okay, in that case, a provision to be created in the profit and loss account. And of course, the money which is remaining in your margin account will be shown as a current asset in the balance sheet of the client. And we talked about the final settlement and also the case of default. In case of default, the money will be taken up from the margin money. The money required for settlement will be taken up. The payment required for settlement will be taken up from the margin money. If that is not sufficient, of course, the broker will go with the procedure through which the money can be discharged either by selling of the collateral or maybe through legal procedure, right? If in case of default, if there is after settlement still there is money which is remaining in the margin account of the client, that will be paid back to the client, because in certain cases the margin money might be a little higher than what is required for settlement of the trade. In that case, that will be paid back. Okay, so what you have to remember is the deposit in the margin account is like, when you are going with the manufacturing process, you have to purchase stock. You have to invest your money in stock, right? The money will be recouped only once you make the finished products, sell the finished products, right? This business is like that. Once I'm trying to enter into a future contract, I have to deposit money in order to enter the market, and that money will be called as margin money. It is actually a risk management technique, as we say, it is used for containment of the risk associated with default in payment. That's the basic purpose behind that. Above all, since in future in standardized system we go with fair value, mark to market concept comes. So again, the requirement will vary according to the performance of the financial asset in the market. That is also one purpose of keeping up a margin account, to maintain